Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. When it comes to investing, one of the biggest things that new investors try to do, and really all investors try to do, is figure out how not to lose money. And while it is impossible to be perfect 100% of the time, there are some ways to avoid, taking a long walk off a short cliff. For those who are country, think about that, and you're going to figure it out here before the end of the video about what taking a long walk off a short cliff means. Basically, there are some things that you can see from around the corner. And to illustrate this, I want to talk about Target and their earnings report today. Now, if you remember, I sold Target earlier this year because we saw this coming from around the corner in some ways. We don't have a crystal ball, but we did know Target had some significant issues. Target wasn't used to making money the way that they used to, and it's just not going well, okay? And we need to talk about like how we saw this, and then how can you take what we learned about Target and apply it to different areas in your portfolio so you can become a better investor. And again, this doesn't mean you'll never lose money in the stock market. Every stock that you pick is going to be good, but the objective here is to be right way more often than you are wrong, because that, again, is what's going to help to build wealth for you down the line. So I have a few points that we're going to talk about for Target, and we'll kind of go through and, again, take this and apply it to any investment that you are currently in. And I'm telling you now, it can be extremely helpful. This is why you want to read earnings reports for the companies that you are invested in, those that you are, that could be competitors to what you may be investing in, and things that you just have on your watch list. So, for example, if I owned Walmart announced their earnings yesterday, I may still want to read about Target, see what's wrong with them, see what's up, right? Those are major competitors. I just want to have, just a lay of the land, and gives me a better picture for what's going on. So let's go ahead and discuss Target very quickly, and again, pull out those key points and apply it to other areas in your portfolio. So first of all, Target is not doing well. Okay, and one of the reasons why I said back in the summer why I didn't want to invest in Target anymore is because I like to compare apples to apples as much as possible. And when I say that, I mean I'm comparing Target to a Walmart. I'm not going to compare Target to Google, right? That's not really a great comparison. But for example, Target is down 28% in the last 6 months and down about 39% over the last year compared to Walmart. Now, Walmart's not doing amazing, but Walmart is up 0.7%. We're talking about the thinnest of margins here. And if I look at the past year, Walmart is up about 2.7%. Again, not great, but which one do you want? Do you want a 2.7% gain over an entire year, which is low, or would you want to take a 39% drop? I think the answer here is pretty simple. So when I start to compare and see, hey, y'all in the exact same business, in some cases you're selling to the exact same customers, why is one stock completely failing and another one is not? That's why we want to look into earnings reports, and why we want to take the time to understand like what is going on the financial side. Like, are y'all making a lot of money, or you're not making the money you expected? Last time we talked about Target, we found out they were mismanaging a lot of their inventory, and they couldn't sell a lot of the things that they thought they were going to be able to sell. Back then, their problem was home goods. It was dressers and beds and all the nice fancy things that people were not buying anymore, and they overbought in that area, couldn't sell it. That was an issue. Now you got a completely different issue. Well, I came across an article today where they are losing $400 million in theft. And they say it's an organized crime thing and all this other kind of stuff. And I mean, that's a huge number. That is a huge number. And yes, there's theft in every single organization when it comes to retail, but that's bad. That's real bad, right? Losing $400 million like that, especially when you start to look at how much money Target's actually taking home in terms of net income, the money they have after all the bills are paid. So I will read off some of the things that really stood out to me when it comes to net income side, and this is that screaming sign that's telling you, hey, something is wrong with Target here. Okay, so I'm not going to read as many numbers as we did last time, especially for those who may be listening without the video, or could be listening on podcasts or anything like that. But here's just a picture here. Okay, so for example, we have in Q4 of 2018, right, before the pandemic, before the world kind of fell apart, their net income was $799 million. Okay, now think about that. 2018, Q4, right around Christmas time, almost $800 million. $400 million was in theft this year. So that tells you that's half of their profit in 2018. Again, a huge number. Now, as things start to progress, for the most part, with the exception of the first quarter of 2020, we know what kind of happened there. Target was pretty steady in terms of profitability. Then in 2021, things look great. This is what fooled me, honestly, and why I started to get in, is I got in at the end of 2021 thinking that trend was going to continue. It did not. So when we start to move into 2021, you start to see really an average net income above $1 billion. So you got in Q2 of 2020, you got $1.69 billion. By Q1 2022, you had Q1 of 2021, you had $2.1 billion in net income. Things trending up. Your net income doubled, right? You had $800 million back in 2018. Then you start to get above $1 billion in 2020, near the middle to the end. Then you're already up to $2 billion in 2021. Again, things are great. Until you hit Q2 of this year, Q2 of 2022. So you went from Q1 of 2022, $1.01 billion in net income. Great, solid, things are fine. Then you drop. You go from $1 billion to $183 million in net income. $1 billion to $183 million. You lost a zero here, okay? That's not good. That's not good at all. And now in 2022, you only have a $712 million net income. Now for an individual, that's a lot of money, right? But think of what I just told you. You have $712 million in net income in 2022, right? Q3 of 2022. You had $800 million 4 years ago. 4 years ago. Okay, so you are not making the money in terms of net income that you were making not only last year or the year before that, but, it's COVID, I'll give you that. But if I'm going all the way back to 2019 and 2018, you're not making the same net income. Now, yes, there's a lot of factors into this. Yes, theft factors into this. Inflation factors into this. But here's the thing. Target is not the only company in the world dealing with these exact same issues. Walmart is not seeing the exact same issues. In fact, when Walmart announced earnings yesterday, they said, hey, look, it may or may not be a recession, but people are still spending money. Target, on the other hand, saying, look, I don't know what's going on here. People are not spending money. People are stealing. I don't know, right? And that's not something that is good if you are an investor in Target. And these are the things that you want to pay attention to. The crux of the argument here is pay attention to the business that you own, right? Because if you own a stock, you own a business, and you need to pay very keen attention to how that business is doing. And right now, I'm not telling you that Target can't recover and Target won't be, the Target of old, but there's a red flag here. Now, one of the reasons why there are differences between Target and Walmart, one, Walmart is much bigger, right? There are way more locations, way more states, way more employees, and same thing with Amazon. And those companies have greater bargaining power, right? If I can say I can buy, 100 million items, you may negotiate with me. And if somebody else comes along and say, look, I can only buy 2 of these things, I'm not cutting you a deal, right? I might not cut you the same deals as Walmart, right? So this is the business part of it, right? This is understanding the business side of things and knowing that Walmart and Amazon, way bigger players, they have a much better negotiating power when it comes to buying certain items in bulk and then selling them for a higher profit margin, whereas Target may not, or in fact, Target does not have that. We also know that the clientele is a little bit different, right? Target is known to have a little bit of we can't say luxury necessarily, but Target is known to be nicer, right? Target is known to kind of bring in people who are trying to move up in the world, if you will, whereas Walmart will take literally anybody at any time because they're 24/7. Target is not, right? So they are catering to 2 different bases. Some people are already coming out and saying, look, this is a symptom of the quote-unquote white-collar recession. So those in the tech space that are experiencing massive layoffs, those are the people who mostly go to Target. Those are the people who are mostly getting laid off right now. Therefore, Target is being impacted more than a company like Walmart, where regular 9-to-5 non-tech people are doing just fine in terms of retaining their jobs to this point in time. And in fact, here's the thing. Should you, I don't want anybody here especially to lose their job, but if you were to lose your job and you were shopping at Target, you fall back to Walmart. This is essentially what happens, right? Because Target tends to be more expensive. So I go back to Walmart. Walmart is a fallback plan. It's the default for many people because there's one in every city, right? Mostly. There weren't any in New York City when I was there. But in either case, right, that's my fallback. Whereas, you know, if you can't shop at Walmart, I mean, it's really Dollar General and Dollar Tree after that, but Walmart is like the home base, right? We mostly all start at Walmart and then go to Target and all these other places. So these are other things that you want to pay attention to and things you have to start to examine when it comes to Target. And I have one other point that I wanted to bring up. I just want to make sure that I am going off of my notes real quick, because the partnership thing is another aspect that I brought up. We had talked about when Walmart partnered with Paramount. That's a value, right? They have the Walmart Plus program. Now, Target has a partnership with Shipped, and they have basically like one-day shipping, which is really cool, by the way. But again, who are you streaming with, right? What is the advertising to get people into this partnership? I haven't really heard that much. We already know what Amazon and Amazon Prime is doing when it comes to groceries and Whole Foods and streaming. The NFL Network, like they got all types of stuff and benefits for people who are, you know, not necessarily tied to either one of these, but there are benefits to sticking with Amazon Prime, whether you like it or not. There are benefits, obvious benefits when it comes to Walmart Plus program. Target is a question mark. These are the things that you have to pay attention to when you are taking these concepts, not necessarily Target by itself, but these concepts and applying it to all of these different businesses. So if I'm investing in, let's say, American Express, which I do own, I need to compare it to Discover Card. I need to take my Discover Card and compare it to MasterCard and Visa and apply all three of these things. They're all in the same area. They have different clientele. They have different types of businesses. How do I take this knowledge about how well they're doing financially and compare it to the others? How do I take this knowledge and say, well, what is going on in the stock market? What is going on in the economy? And how can I tell which one of these four companies I should own and which one is going to be best for me? All right, now you are thinking, well, how do I do that? How do I analyze all these statements and stuff? Guess what? We talked about inside the members only. I talked about financial statements and understanding and analyzing how to really break down the business side of this and understand what is going on in these financial statements, how to find out about, you know, gross income, that is, or the amount of money that's coming, gross profit rather, that's the amount of money that's coming in after the main bills are paid, and what that means for a stock, right? What that means for a company and how that can help you to determine whether or not this is a good business to own. And usually if it's a good business to own, it's a good stock to own. If it's a good stock to own, it can help make you wealthy over time. Not overnight, but over time. All right, so you want to make sure you check out the members only. Make sure you hit the like and subscribe. If you have any questions, comments, or thoughts, meet me in the comment section. Y'all know I be in there. All right? Okay, that is it for me. I'll see y'all tomorrow. Bye.